Okay, so today we will be talking about what kind of strategies are there available to deal with the exposure, because last time uh, we were talking about that, at least for seminars, but now we will see also the definitions and so on. And then we will define the different categories for them, and also we will define strategies to deal with them if we have to deal with them. So first of all, the book talks about the relevance of the exchange rate risk completely. So the book says that, okay, there are three different arguments. First is that the purchasing power parity argument, and it doesn't matter when exchange rates are changing or currencies are changing, because prices of the goods will be the same or similar in different countries, because there will be foreign trade to balance everything out. Just we know that this is not the case, because there are, okay, of course, there are tradable goods and services which can be moved from one country to another, but many of them is local and you can't move it. So like I have that you can use the service there, here, and that's also you can export this. So as a result, still exchange rates will be relevant. So just not just the inflation differential will be what will be important here, but also the currency. Uh, Also investor hedge argument. So we can say that it doesn't matter for companies to hedge their risk, because their investors can do it. But obviously for a company which can be considered as a wholesale operator on the capital market, can have much better conditions for buying an option or to use any kind of financial innovations than a retail investor who has to use much better margins or much bigger margins. So it's no, this part is also not that good, and still the company can go to default if they have some unhedged risk, which is not, it also can harm the investor. So that's why you can see that risk management is much better to do by companies instead of their investors. And the last one is currency diversification argument. So maybe if the company has diverse enough incomes in different currencies, then actually they can be free of any kind of harm coming from the exchange rate, which seems to be nice. Just if we are going back uh, to last week's slide, we are using it for 3 weeks now, but there is the BPC dynamic conditional correlation, and if we remember on it, then actually we can see that, yeah, it's nice to say that, oh, we can build diversified portfolios. It's just, even if when so different currencies like the euro and the Japanese yen have sometimes increasing correlation among them, then it's really hard to talk about any kind of diversification. So usually the weight in a portfolio would change drastically, and that's why it would be probably useless to do. Most of them are positively correlated. Yes, 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 yes. So it's only when we were looking on African currencies, the African free floating currencies, we were able to find euro correlated or even euro correlated currencies, because nobody invested into them. But for example, even in South African rand, there was significant correlation doing this many years ago. So actually we can say that no, we can have the benefit of diversification. So now we have to see that what kind of risks are there for us. So first of all, we have to talk about translation exposure. So So when the company creates the annual reports, we know that all exchange rates or foreign exchange based data should be transferred to the parent company's currency at a predefined date. So usually this is 30th of March or something like this in the next business year. And, and it can create biases because maybe you have some exposures in the past under completely different exchange rates that now you have this. But actually, mostly it happens on the level of accounting. So this is not affecting the level of cash flows. So somehow we can say that, oh, it's still artificial, it looks nice, but yeah. Transaction exposure, this is what is happening with, or this is what is affecting the cash flow level. So in this case, then we have to realize the income at one exchange rate and we have to pay for expenditures under another exchange rate. So in this case, we have to estimate the net cash flows in each currency and then we can model what is happening there. Yeah, so this is when things can go south. To look on our data set, we can see that something like this can happen for our company. So let's say that this is January. So it's not continued. Okay, so first month, second month. So there are expenditures for all the months, and we have income here. Then, obviously, if exchange rates are changing constantly here from month to month, then it can have an impact also on the profitability here at the end of the day. So we can say that uh, also, we know that it's still not a problem for the company, but we can say that let's make up some numbers, some optimistic numbers. Then market hits the market. Okay, not that one. Yeah, let's have an optimistic closure here. So, obviously, in the case of expenditures, if we have 1,000 euro expenditure and 1,000 and the same amount of 16. Yeah, okay, right now I can well. And everything in usual phase will be affected, so we are summing them up. Actually, we have a nice data here before. still the company is profitable, while at the same time we can say that this here we are completely zero. So yeah, this depreciation is beneficial for the company, but if if it happens in the opposite direction, then actually this position can be losses. So that's why somehow we have to deal with this problem. And even when we were talking about short-term financing at the end of the semester, then actually we can say that okay, but we have to take a loan, take up a loan in this currency from month to month. And at the end of the year, we have to pay back all the annual debt from this. So actually, this number will be bigger here when we are coming up everything. So that's why transaction exposure can be much more significant. And also economic exposure is, so until these exposures are happening mostly on short-term basis, so within a year, so within a fiscal year, then economic exposure is much more like a long-term issue. So if the currency is constantly depreciating, obviously there will be problems with the demand soon in this economy. So the value of the company also decreases. So it's funny to say from Hungarian point of view that, oh, we made some money with this depreciation, but at the same time, the value of the company also decreases because.
But isn't it dependent on which country's stock exchange?
Yeah. But if we are a foreign investor and we purchase or buy all the shares of this company, then we have to run for our money because this depreciation decreases the share package in our hands or the equity package in our hands. Okay, if we are able to improve the profitability of the company, then we can compensate this, but we will lose some of our investment or the productivity growth because of this depreciation. Or we can say that actually it creates cheap companies. So if we are looking for companies to be a subject of some sort of takeover, it can be offsite takeover, it can be merger, acquisition, then it creates cheap companies. So it has also the benefits because it's nice entry point. Just if we are already in a position, then appreciation can be much better for this. Okay, so then let's see that how can we measure the exposure. Actually, uh, we did this on the seminar. So when we are calculating all these expenditures and income, then yeah, we can measure it. Actually, the book says that we should think about the structure of the portfolio. So. mm So what is the base of the different currencies, and then what is the standard deviation of this portfolio, and after that we can optimize that how should we rate these currencies. So in this case the euro and the Czech too, but we have a very diversified portfolio here, and actually we can do it. So also, another way, when we want to say that we want to have some cut-off exchange rate, when we want to define it. So, if we want to say that we don't want to allow our cash flows in the currency or against the currency increase by 5% of low probability margin in both directions, then actually we can multiply the standard deviation with 1.65 because it represents under normal distribution assumption the 5% of probability. So in this case, if we are multiplying the standard deviation with this number, then we have the amount of change by this 5% probability, and after that we can say that if we are reaching this level, we can say that now we will use some financial derivatives to hedge your position, or maybe if you are reaching this too many times, then we can think about that maybe we should reduce this exposure. For example, in Czech koruna, then we start firing people in Czechia, or we start to realize some income in Czech koruna. So some sort of strategic or particular. Oh, yes, or options we can purchase. And of course, sensitivity analysis can be useful. We did it on seminar, so nothing new here. But let's see this exposure issue. So, what we have here, why don't we have here? Okay, yeah, because I just saved. Okay, so we will have here other exchange rate. Okay. So we have euro, and actually in this case, when we want to compute something like this, it's no, we will change this denomination. Euro and take it out. And from 2006. Actually, oh, yeah, it's always the same button. For some reason, I have it. I don't know, if you want to fix this, we have to use the data difference. So, what models are not working well under mostly or VP data sets. So, generally, one deeply, so, run of the CSV, somewhere, yeah, data, new report from 5 CSV, oh, account. Oh, now it's we have to, first of all, we have to include this stupid decimal point that we not want to change. So, we have to. Then, now we go. And we still have absolutely no idea about what is the number. Yeah, we can delete it. And this is longer than the data was proven that. Oh, and now we can hopefully calculate the base. For this case, we will use, first of all, I will increase the size because it's really good with more. So font size plus 10. Wow, I think it's good. probably that can we do this company or not? Here, reading visual, so we are loading everything from here. Okay, I did the mistake in Matlab and I think it's frozen. I have to close it down. So, in the past there was a button for that to start any kind of processing, but now it's not there. So first we have to define the steps. So okay, now it's frozen. So first step we have to say that we have to calculate the weekly standard deviation. Actually not standard deviation but weekly variance, covariance matrix between these currencies, and then we can calculate the rates. Yeah, but to do that you can see that in many cases we have to use other currency as a denominator. So right now if we would calculate correlation for these two things, it would be biased. So we have to add also external currency because otherwise it will not work well. And it's much better to calculate everything in Hungarian forint basis. Because otherwise we can calculate correlations. Uh, but uh, with a smaller number the leverage is, I don't know why, but it's a terrible behavior at Stockholm because
USD because compared with euro also.
Uh,
Euro check because corona and
yeah,
euro no.
just in this case, I would not be able to calculate the correlation pair because when you are calculating correlation pair, you will lose one currency. So if I calculate in just Czech krona and Hungarian forint and euro, then there will be only one correlation among them. And in this case, we can't say that what will be the rate. But yes, we can say. Okay, you are right. So we are doing it for analysis, it's not working, but in this corporate case, it can. Then let's start again, just now without any kind of trading. Okay, data is done. No. Yeah, this one. But it's funny because if I'm loading it manually, just copy, paste. No, it's here. Oh, come on.
It's manually inputting.
But usually we can walk it around.
Just put this one.
Yeah, there will be other numbers. So here as well, here and here. So yeah. And also we can have it walk around when we're loading it manually. On the start data and if one starts to open it up. Yeah, now it's able to recognize that it is a number here. So it's there. But it's not good because I downloaded that. Can do it just as a matrix stuff. Because now it also defines tables. I don't want to have tables. I want a special matrix. Now it's able to read it. So the same command what I did
What happened before?
Excel. Excel. So if I copy it here, oh, that's not that compatible now. But you can see that now it's recognized as a number. Before it was not recognized. But now, we are doing the loading again, and there is. Okay, so how to spend precious time of your life on stupid things? Then this was one of them, and then CZK will be for data. That was the first column, and also everywhere equals data. The last column, there. And after that, we can say that. So we have to convert, before any kind of further analysis, we have to always take the logarithmic differentials. So we have to take the check runas, so, and also the output, and then we have to check also the changes, so this like differential. Why we need log? Actually, because here it's we are calculating in hundreds. Here we are calculating in decimals. So we have to put them together to be scaled similarly. And differential is because we need everything with zero mean to have an operational model. So now we have all the logarithmic changes, and we can see that we are fluctuating with a similar scale. It looks like a caterpillar, but still we can say that lines are similar. There are no sudden outliers, just here at the 2008 size. So after that, then we can calculate the time variance, covariance matrix. So in this case, we will have a covariance variance matrix for each day. So it looks like this. So it looks like that we have the CJK dual and output, and here will be the variance of the test luna. Here will be the variance of the zero, and here will be the covariances. Then, and it will be can be defined for each day. So for in this case for this. So we can know this, and we can say that firstly, then we will have a bit similar or different data for the second week, and so on. So it will it's like a case kit in the bit before that they are on the top of each other, makes it look like this. And naturally we can build on them. And to estimate them, we will need the dynamic conditional correlation, which was developed by Robert and actually he got Nobel Prize in economics in 2003 for developing all the Gauss models, so dynamic conditional variance. And then when he got it in 2003, actually he published also in 2002 this dynamic conditional variance covariance matrices. Because before of that nobody was able to calculate it well or estimate it well, that how correlation changes in time precisely. So since 2002 we can do that actually. So we just really nice guy to make this happen, and LSA Toolbox provides us this for estimation, and this is the obviously it's called DCC, so dynamic conditional correlation. Yeah. So actually it's dynamic because somehow they have to call it, so it's changing in time. Conditional because it's function of time, so for each time t, then you have a number, and it's a correlation because actually it's not a correlation because it provides just a variance covariance matrix, uh, but yeah, this is how they call it.
What did you load in the document?
Yeah, uh, actually, so this is, it says the uses, but this part is useless, but all the inputs, I will talk about them right now. So from the output, actually, we just need the HT, which is the variance covariance matrix. So this is what we here, what we are looking for. The data will be the rest. So all the returns we find here. The data thing actually I never used it. So and also people are never using it like visual anti-matrix. The R, M, R, and N variables. The order of symmetrical innovations in the model. When I checked also the literature, it was always switched to 1 or turned to 1, so I don't want to linger with this. It's good enough for us. Then the P, O, and Q will define the underlying part order, which is usually 1. And after that, is this on squares or not on squares? It's always on squares, and other variables are just optional, so if you are looking on the description, then it says that we don't want to. Because we don't want to have 3-stage or 2-stage definition, so we are using just the ordinary definition of the DCC model, and then some calculations will happen. And we can it. And now we have the variance covariance matrix, and actually we can see here that it looks nice because this is defined stamp. So this is for the first week, this is for the second week, this is the variance of the check krona, this is the variance of the euro, this is the covariance between them. So we have to be happy there. And after that, we can calculate the correlation. But yeah, in this case, that would be really long, so I will. Okay, so actually, if you want to calculate all this stuff, we just have to open the spreadsheet, which is already there. Yeah, because we know that we have to take all the covariances, so discrete command actually takes numbers precisely from the same part of the equation, and it goes through each part, and in this case it collects all the variance, all the covariances, the variance, uh, for A, variance for B, and then we just have to calculate the difference between the covariance divided by the multiplication of the two variances, standard deviations. So, this is the first easy. Yes, 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 it goes. Yeah, so now we can see that something happened here, but in other cases, it was really nice and smooth, and mostly they had really strong correlation until crisis happened or COVID happened or something like this happened. What happened? Yeah, the second is actually the we did start, so we can copy it here, change again. This one. And it was using the first week. And the check room now, yep, and it's not able to recognize it. Yeah. Then just in this case we have the date. You can see that it happened in March. How? But what should be the optimal rate for this currencies? Your portfolio. So this is actually corporate finance. We are always teaching for the case when we have only two currencies and how can we calculate it. But actually, uh, to calculate the weight, we just have to invert the HD matrix and then we can calculate the weight directly. Doesn't matter how much currency do we have. So uh, it's much more straightforward way to say it. In the case of diversified portfolio, we have the lowest variance as possible. And if we put down the weight for each columns, um, and then we can see that for the two currencies we have the following weights.
If the weight is equal to 1, weight is equal to
Sorry?
the weight is equal to 1, so
Actually, so weight should be 1 if you have only income here, and if it's -1, then there is only expenditure. So this is when you have long position, and this is when you have short position in the currency. So, so yeah, it's tricky because actually it says that sometimes we have from week to week business, we have the negative. So actually we have only expenditures, or we supposed to have only expenditures in euros, while we should have only income in Czech kronas, and then we are switching place back and forth. So yeah, it's weekly data, so we should convert it to quarterly data because it can be much more reliable.
But the two graphs are inversely.
Yeah, yeah. So they are jumping around each other. Yes. So even if we are converting it back to weekly, we don't have details, but all the others. Then still we can say that it would be completely useless for the company to follow such a behavior. How now you understood? Well, so obviously the company is not flexible enough to maintain this course because in this case you have to jump back and forth between krona and euros. Yes, and at least every quarter because now it's quarterly data, but still we can, yeah. So still we can say that no, it's useless. So if the book says something like this, then maybe if you have enough currencies, you can maybe do this, but actually, I don't know why I deleted it when I calculated on December, but it looks completely the same. So you can have the diversified portfolio of the real market. So it's not working like this. Okay, but actually, let's see. Uh, so before jumping to derivatives, let's see that what kind of ways are there available for managing transaction exposure, because this is why we are sitting here today. So first, just once we identify the degree of transaction exposure, we did it on the seminar, so we calculated all the income, all the expenditures, then we were able to see that, yeah, what is the money. We can calculate it for monthly level, we can calculate it on annual level. Then we can choose from the following strategies. Total hedging. In this case, if we have any kind of exposure, then we will purchase some option, or we will go to the forward market. Doesn't matter, we will use some financial innovation, some derivatives to trade away this kind of risk. Or we can say that we don't want to care about it because actually this exposure is irrelevant for us. Or we can say that it's too for some profitability. So if you're looking on the euro, it is depreciated, or the Hungarian forint is depreciated against the euro, but it's good for profitability, so I don't want to use corporate resources to hedge this risk. Or if the company would like to behave like a very diversified portfolio, so if the weights here would be stable and would describe structural behavior, then we would be able to say that, oh, it's also serves the company, so we don't want to hedge. Or we can have selective hedge, and then we are looking for some external benchmark. In this case, let's say that, for example, we can look for the variance of the data. So, here, let's look for the variance of the euro. This was the second thing. So obviously, when the variance of the euro increases, then maybe we should do something because the market is not sure how to price in the euro against the Hungarian forint. And when they are completely calm, then we should not purchase anything because actually options are expensive, so we want to reduce or avoid such payments. So in this case, it's completely up to the company that this one is chosen. This what will be we will check it on seminars that which strategy can be suitable for the company.
Maybe the small companies never does.
No, usually not, but after that, usually they are losing money on it. So that's why they're supposed to. But small and medium enterprises are usually trying to skip this, and until the situation is favorable for them, then they can do it. Just we know that every decade there is a year when things are going crazy, so it can be harmful to live like this kind of thing. And and actually, after that, when we were choosing the strategy, when we were choosing the currency, the exposure, and so on, then we can say that, okay, now we have to look for the right derivative for the company. So this is when we can start to think about which derivative can be useful for us. And the first candidate would be the currency futures contract. So if uh, last time we were 2 weeks ago, no, sorry, last week we were talking about futures market because after I was talking about all this neural network funny part, then I was showing you some market data when actually they were uh, trying to price in uh, Czech krona for different time periods uh, ahead of time. So actually you are able to make contracts to defend yourself against it. Just I also mentioned that I personally I don't like futures markets because they are simple on one hand, because right now you are making the contract that such amount of Hungarian forint I would like to convert to Czech krona within a year or within a month in a predefined time period and at a predefined exchange rate. And once you sign the contract, virtually, obviously, then it's mandatory for you and for the other partner. Usually this other partner can be a bank, it can be also another company, but you will have securities account or trading account on the local stock exchange or at a brokerage company. Usually it's a brokerage company. And the problem is that at the same time you have to put uh, so at the same time when you are creating this contract, then you have to have margin, a futures margin on your account, and you have to keep it as a deposit. It's not an interest-giving deposit, just you have to keep the money there because it secures your payment. So if you are not able to deliver, still this money can be used to fulfill the other side of the contract. And actually, the amount of futures margin is not well defined for me. So the book says, or if you are looking on the internet, the literature says that typically 3 to 12% of future contract fee, but it can be half of the face value of the position. This depends on market situation. If the volatility increases, somehow this margin will catching up, but you have to keep that. And if you are not able to meet with this margin requirement, then actually the brokerage company can say that now the contract is closed and you are losing the money, what you kept as a deposit, and also you don't have the security anymore there, so you lost your futures position. And
futures market equities are tradable, right?
yes, they are tradable.
Not like forward market.
No. Because in the forward market you are making the contract directly with the bank and not on the stock market. Actually, fees are much better on the forward market, but they are not transparent. Usually they are following the futures market as well. Just my problem is that if there would be any function which would describe the relationship between futures margin and actual market volatility or some underlying conditions, then it would be nice. But in this case, I'm always have a doubling issues with this because yes, we have to see this and people and companies are using it a lot. Just
does it depend on the credit rating of the company?
yeah, yeah. So it depends on many things, but it's highly undefined that what is happening here because there is the initial margin. So when you are making the contract, then the funds are required by the clearing house, but then you have to maintain it. So sometimes if volatility increases, then they can say that now we have to increase the amount of money in the system, and yeah, and it can have issues. So liquidation can be, or position can be reduced as well. So it depends on the type of the contract. And as strategies, so offsetting or liquidating the position can be happening. So actually, you are realizing the profit without delivering any kind of assets, physical, like if you are making futures contracts against crude oil, you don't have to deliver such amount of tons of crude oil, you just pay the money. And or it can be a rollover, so you are moving from this mode, the contract to the another mode. If you are say that okay, actually the market was changing in my favor, but I want to keep or maintain this exchange rate futures, then I will just move it to the platform. Of course, in this case, we have to also pay some sort of money, just it's not visible for us. So, or you can go to settlement. So actually, literally, if you have this expenditure, or if you have the oil, or you have the grain, then you are delivering. Usually, this is not the most significant segment of the market. So usually, even companies which have the grain that they will offsetting, and then at the same time they will deliver, but they don't want to go through all the procedures. And actually, in the case of exchange rates, we can say, or in the currency market, we can say that the spot rate depends on expected interest rates between the domestic and the foreign currencies. So So if we are dividing them, then we can have the future price, but since it's expected interest rate, then and it can be anything. So usually when we are analyzing future prices, then future prices can be a really good indicator to see that what are the expectations about future interest rates. Is the market expecting an increasing interest rates or not? So it can be sometimes much better solution to use future prices. Yeah, forward contract, as you mentioned, with banks. Uh, and now my favorite. So, in the case of options, they are much better because, at least for simulation or analysis purposes, they are much better because in this case, it's not mandatory to fulfill the contract for one party. In this case, to this not obligatory issue, then you have to pay premium. So it means that you are paying the option fee, and in this case, if you are able to say that, okay, but exchange rates are changing in my favor, then I don't want to execute the conversion from one currency to another currency, which was not the case for future contracts, so instead you have to deliver doesn't matter what. And in this case, call option means that I would like to purchase currency, and the put option says that you have to sell this currency. So we are changing the denomination from one to another. So this is different between call and put options. And yeah, one more thing is that European option can be executed only at the expiry date. Yeah, and American option has been executed every day, so they are a bit harder to model because European has a much simpler mathematical model. And mostly this this is called this Gardner Cohagen, but actually it's a black source model. Just they added the differential between foreign and domestic interest rates. So this was all the added value here. And the rest looks like this, that we have the spot price, we have the target exchange rate in the future. Obviously, we have to look for the difference between them. So if they are the same, then the option will be the cheapest. If they are away from each other, then actually it will be more and more riskier and more expensive for the other parties to fulfill the contract, so it can fail. It can have a price impact. Also, what is important here, the interest rate differential, because if this interest rate differential increases here, the option will be more and more expensive because usually when a company or an investment bank on the other side of the option, they are purchasing government bonds on the other side to hedge this option exposure, and so they have to build it up, and of course, if this is increasing, then it makes the option also more expensive. And the last variable here is actually the risk. So the variance or the standard deviation of the position, because obviously if the standard deviation increases in time, so it looks like this ugly thing here, then in this case, when the market is absolutely not able to price in the Hungarian forint against the euro, then obviously it's much more riskier business to have any kind of option contract to maintain, because nobody knows what, then how can you, as other partners, who will write out the option uh, to hedge your risk? While at the same time, when you are here, so the standardization is really limited, then it can be not so risky just for you. So in this case, option prices are decreasing. And of course, we have a time variable. Uh, Usually we will be calculating with 1 year option fee because this is the simplest thing. But of course, we can calculate monthly, 2 monthly, and so on option fees as well. Just we have to remember that we have to use always annual terms. So if we are calculating it, then the number will be always 1 for annual option, and it can be 1 divided by 12 for monthly. And actually that's all, because after that we have normal distribution assumptions behind that. There are nowadays better and fancier models to avoid normal distribution, just usually they are not public. But in Matlab nowadays we can have something, but mm, yeah, but more secret, and usually so this gamma Hagen is the most robust. So this is what's supposed to be there. And after that, if you are starting to move away from this, then okay, your option fee can be narrower, but if there is a shock, then you can still suffer more. So what is funny here that actually, if we are Bloomberg or in the Thomson or earlier Thomson writers on our Acon database, usually they are just providing such assumptions. So in the Bloomberg, actually you have test on option as well, but it's also based on normal distribution assumptions. Uh, it is a bit strange, but that's all what we have here. Yeah. So before moving to the Aston nightmare, actually let's see that how can we work with this in Matlab. And first I will save everything what is here. So here it was much more important to write or to prepare the script before the class, because it requires much more time. Uh, so actually reading the data in, then what do we need here is the Czech krona Hungarian foreign exchange rate, the two uh, interest rates for Czech and the Hungarian currency. They are long-term uh, interest rates, and also there is the currency. Then we need a Gauss model. It will be a Gauss 1-1 model with a normal distribution. Uh, because in this case, actually we could calculate just the standard deviation of the data. But in this case, if you are calculating the standard deviation of the data, you will get just one number for the entire length of the data. And at the same time, here we have, yeah. So here we have data points for the entire uh, time step. And it's much more reliable. Usually, you are operating on real-time basis, so this is what we were downloading last time. So we can always define our models, so adding newer days or hours or minutes to this, and then we were always up to date with, and now we can see that right now the volatility is 8 something. And then we can move on and we can update them. And in this case, the pricing of the option can be much more realistic, because also past data is inflated away by the past model, so they are not that important if we are calculating everything is just a simple standard deviation. So that's why nowadays it's highly requested to have this fast model because we are making everything simple, and actually we can see that it's just one line code, so it's also simple. And we need obviously the usual uh, logarithmic differential for the input data for the currency, and after that, this is the entire Garman-Kohlhagen model. So we have the spot rate, that is the target rate. Actually, it was switched to spot rate to hedge, but we can say that, oh, we don't want to do this, let's say, and Czech krona to Hungarian forint, and it's usually around, fluctuating around that. So if we are saying that, oh, we started our business here in 2006, then it will be 8.7. Much more realistic. This target rate remaining time in years, domestic interest rate, foreign interest rate is just calculated here. Then we have to take the square root of the HT because HT is variance and it is standard deviation, so that's why I'm square rooting them. And after that, this one is actually the function. So this is the same thing like this was here. So actually this approach requires no toolboxes at all, just you need to have the NLP toolbox which is free of charge, and this is the simplest way. And this approach will calculate an option fee both for call and put option fees for each date. So we can see that how this was changing. So we can have to see that how the call option fees are changing. So obviously when we were moving away from the initial state of having this 8.7 krona interest rate, then to have one Czech krona of this option of this exposure, then we have to pay 1 foreign, then 7 foreign, then 8 foreign, then after that it went down to something, yeah, 1.1 foreign. So we can see that it's a highly dynamic thing that we can have. But also we can do the same thing with the fancy financial instrument toolbox in the Matlab, because actually right now I can't see the added value, but I did it anyway. So the beginning part looks like the same. I don't want to execute it because no, we have to. And after that, I was digging up all the inputs. Uh, and still we did sigma, we did foreign rate, and some why, I don't know why. So they define this time date definitions. So they are not saying that. So here in the original model, you have to say that remaining time in years, lines of options. Now, there you can calibrate that, oh, it's for 1 year and for which date. And maybe in practical life it can be much more useful because also at the same time you have to calibrate a parallel bond rate. So when the bond is settled and when the bond matures. And you have to calibrate only for domestic bond, not for the foreign bond. For foreign rate, it's just foreign rate and that's all how it's calibrated. But for the domestic exchange rate and interest rate, you have to do all this mingling, and I can't see the practical part of it. And after that, you have to calibrate these objects in Matlab. Uh, so you have to say that okay, it will be vanilla option, then it will use black source model. So I mentioned that Kalman compiler is a derivative of the black source model. Then this is when the rate curve mumbo jumbo will happen. Then pricing should be defined, and then price will be added. So all the inputs defined here in earlier step will be added here in the pricer function, and then we will have a price here. So I was writing a for cycle for that. Oh, somebody just used. I need data. No. Well, you are not able to find it. That's why. Ah, because I'm in the wrong folder. No, you can. Ah, because I did not update the file here. So it's supposed to have actually completely the same result, but in this case, this is the built-in function for Matlab. And actually, we can change many things. So we can switch this from European to American options. So there are some fancy approaches what we can change here, but mostly that's also European. If you are turning to American, then it will be another. But I can see right now that what is the added value here, because they made it just more complicated and there are much more switches. But yeah, the first session way was easier. Simpler. So we can see that the output is the same. So increasing, the top is the same, the bottom here is also similar. Yeah. So actually we calculated the same thing. Uh, but what will we prefer in the case of options, that it has a price which can be assumed by a function. So it will be really useful for us when we are evaluating different hedging strategies for the company. In the case of Heston options, I obviously I don't want to ask about it on any kind of test. It's just to show you that what is the heavy machinery here. Uh, Actually, in the case of Heston options, then they are not just talking about that the standard deviation changes in time, but also what is the mean value of the standard deviation. There is something wrong, so maybe I have to show. I will also create. So this is here you can see the actual standard deviation, not just the variance. So actually what is the mean value of this? And if it deviates from the mean value of the standard deviation, then what is the speed of going back to this? And also how this deviation correlates with changes in the price of the exchange rate. So if the price increases, then variance increases or it decreases, because it can be also contain some information for pricing in the option. And Here there was something. Yeah, and the standard deviation of the standard deviation, so how volatile it is. So it has many disgusting components, and sometimes it's really hard to say that how you calibrate it. So when I was looking for it in the literature, and I was always checking the original papers and the papers which were applying Haskell models, here there were functions which were saying that it should be two. And, okay, but why? Yeah, so there is this Feller classification which says that, oh, we have this kappa variable and you have to calculate this. So, and why? So there was no further definition, just, okay, I'm an economist, I can understand it, and then you do estimated like here. But just usually when the crisis hits the market, then usually these estimations are going south with. Also, uh, there is volatility described here, so the Gauss model is defined well. Yeah. And there is still there is this problem. So someone I did move it so many times, but now it's so easier Gauss model is always on squares and Gauss model is always not on squares. Yes, yeah. Um, and also the lecture notes are describing different strategies, so how can we build up strategies between call options and put options uh, to defend ourselves against changes in both directions. Uh, so you can read this, but you not ask it on that. Uh, and even, oh my god, Haskell model is here as well. So if someone is interested in Haskell model, then actually there are all the variables described. Funny on, I will teach it tomorrow for Hungarian students on investment lecture, but it's not for today. Okay, then that was all for today. Next week we will playing with swap agreements because they are also disgusting, but and there are more because options are still we have one function to play with, but in the case of swaps, much more wanted.